Most people think parking cash in a high-yield savings account earning 4% is the smartest move. But after testing both high-yield savings accounts and the Fidelity Cash Management Account with real money, the hidden differences shocked me. One gives you flexibility that could save you thousands. One locks your cash behind invisible barriers. And one quietly drains your wealth through opportunity costs nobody talks about. Here's what matters to your financial future. The average American keeps $28,000 in savings accounts, earning next to nothing. But even if you're earning 4.2% in a high-yield savings account, you might be leaving serious money on the table. The truth separates into three categories: the access features that determine whether you can actually use your money when you need it, the yield structures that determine how much you're really earning, and the hidden limitations that could cost you thousands if you pick wrong. By the end, you'll know exactly which option puts more money in your pocket. Let's set the context. High-yield savings accounts exploded in popularity after the Federal Reserve started hiking rates in March of 2022. Traditional savings accounts at big banks still pay a pathetic 0.01%. The national average sits at just 0.4% as of November 2025. But online banks like Openbank, Varo, and Synchrony now offer rates between 4 and 5%. That's 10 times the average. The appeal is obvious. You park your emergency fund, earn solid interest, and sleep well, knowing the FDIC protects up to $250,000. Meanwhile, Fidelity's cash management account operates in a different universe. It's not a bank account at all. It's a brokerage account designed for cash management. When you deposit money, it sweeps into either FDIC-insured program banks or Fidelity's government money market fund, called SPAXX. The fund currently yields 3.59% as of November 20th, 2025. Not quite as high as the best savings accounts, but here's what nobody tells you. This account gives you spending features that most savings accounts don't. Unlimited check writing, a Visa debit card with global ATM fee reimbursements, mobile check deposit, and bill pay. All with zero monthly fees and zero minimum balance requirements. Here's the first major difference that actually matters to your wallet: access flexibility and transaction freedom. High-yield savings accounts sound great until you need your money. Most limit you to 6 withdrawals per month before hitting you with fees. Some waive this rule, but many still restrict how you can access funds. You typically can't write checks. You can't use a debit card at stores. Want to pay your rent from your high-yield savings? You'll need to transfer money to checking first, wait 1 to 3 business days, then pay. That delay could cost you late fees. The Fidelity Cash Management Account destroys these limitations. Unlimited transactions. Write as many checks as you want. Use the debit card at any store. Withdraw cash at over 1 million ATMs worldwide without paying a single ATM fee because Fidelity reimburses them same day. Need to wire money? Done. Mobile check deposit. Built in. Bill pay? Free. This account functions exactly like checking but earns interest on every dollar. The flexibility difference becomes massive for anyone running a business, managing a regular income, or simply wanting full control without artificial transaction limits. But here's the catch nobody mentions. This flexibility comes with a yield trade-off. If you choose the FDIC-insured deposit sweep program in your Fidelity Cash Management Account, you'll earn approximately 2.21% APY as of October 2nd, 2025. That's roughly half what top high-yield savings accounts pay. The money sweeps across multiple FDIC-insured partner banks, giving you up to $5 million in FDIC coverage versus the standard $250,000. Great for safety, terrible for yield. However, if you select SPAXX instead, you earn 3.59%. Better than the FDIC sweep, but still below the 4 to 5% range of top savings accounts. The gap might seem small, but on $50,000, the difference between 3.6% and 4.5% equals $450 annually. Over a decade, that's $4,500, real money. Now the second critical comparison: fee structures and hidden costs that silently drain accounts. High-yield savings accounts advertise 0 monthly fees, and most deliver on that promise. Openbank requires $500 to open, but charges nothing monthly. SoFi requires nothing to open, and nothing monthly. American Express, Synchrony, Ally Bank all the same. No minimums to avoid fees. No maintenance charges. The catch appears elsewhere. Many high-yield savings accounts pay tiered rates. Varo pays 5% APY only on balances up to $5,000, and only if you meet specific requirements like receiving at least $1,000 in monthly direct deposits. Everything above $5,000 earns just 2.5%. CIT Platinum Savings pays 0.25% on balances under $5,000, but 3.75% on balances above $5,000. Read the fine print or lose hundreds. Transfer fees present another hidden cost. While most high-yield savings accounts don't charge for electronic transfers, some impose wire transfer fees ranging from $15 to $30. Synchrony charges $25 for outgoing wires. That adds up fast if you're moving large sums for real estate deals, investments, or major purchases. Then there's the accessibility fee, measured in time. Every transfer from a high-yield savings account to your checking account takes 1 to 3 business days. If you need money immediately for an emergency or time-sensitive opportunity, that delay becomes an invisible cost. The Fidelity Cash Management Account takes a completely different approach. 0 account fees, 0 minimum balance requirements, 0 monthly maintenance fees, 0 overdraft fees, 0 transaction limits, unlimited ATM fee reimbursements globally, free check writing, free bill pay, free mobile deposits. The only fee you will encounter is a 1% foreign transaction fee when converting currency at foreign ATMs, but even then, Fidelity reimburses the ATM owner's fee. For domestic use, you'll pay nothing. The real cost appears in the yield gap discussed earlier. Fidelity essentially charges you through lower returns rather than explicit fees. Here's where it gets interesting. Balances above $5 million in the cash management account don't stay in FDIC-insured banks. Instead, they move into a money market fund that earns a different rate and carries no FDIC insurance. For most people, this doesn't matter. But if you're parking serious wealth temporarily, understand the protection shifts from government-guaranteed deposits to SIPC coverage, which protects against broker failure, but not investment losses. The money market fund has never broken the buck, meaning it's never lost principal. But technically it could. That risk is near zero for government money market funds like SPAXX, which invests in US Treasury securities, but it exists. The third major difference determines who wins this battle: investment integration and wealth-building features. High-yield savings accounts exist in isolation. You deposit money, it earns interest, you withdraw when needed. That's it. No investment options, no ability to buy stocks, bonds, or funds without transferring money elsewhere. For pure emergency fund storage, this works fine. For anyone building wealth systematically, it creates friction. You keep checking at Bank A, savings at Bank B, investments at brokerage C. Moving money between accounts for opportunities wastes days and mental energy. The Fidelity Cash Management Account integrates seamlessly with Fidelity brokerage accounts. See a stock market dip? Transfer cash to investments instantly. No waiting periods. No external transfers. Everything lives in one ecosystem. This matters enormously for tactical investors or anyone dollar-cost averaging into index funds. You can also link the account to Fidelity's credit card, which offers 2% cash back on all purchases when deposited into eligible Fidelity accounts. That cash back flows directly into your wealth-building system rather than sitting in a checking account earning nothing. But wait, there's more. The Fidelity Cash Management Account offers automated savings tools most banks don't provide. Set up automatic transfers from paychecks directly into investments. Create multiple cash management accounts for different goals. Track spending with real-time alerts and detailed transaction views through Fidelity's mobile app. The app integration beats most high-yield savings platforms because Fidelity invested heavily in brokerage technology. High-yield savings apps work fine for basic tasks, but they lack the depth and speed of investment-grade platforms. The counter-argument deserves attention. Some investors prefer separation. Keeping emergency savings completely isolated from investment accounts prevents the temptation to raid savings for speculative trades. If you struggle with impulse investing, a high-yield savings account at a different institution acts as a friction barrier. The 3-day transfer time becomes a feature, not a bug. It forces you to think twice before moving emergency funds into meme stocks or crypto. Behavioral finance matters. Know yourself. Now for risk factors and considerations that could derail your choice. High-yield savings account rates are variable and can plummet without warning. In January of 2025, many banks paid 3.8%. By November, that dropped to 3.3% at institutions like Ali Bank. If the Federal Reserve cuts rates aggressively, savings rates will follow. You could wake up earning 2% within a year. The FDIC insurance protects your principal, but doesn't guarantee your yield. Banks can slash rates to whatever they want, whenever they want. The Fidelity Cash Management Account faces the same rate risk. SPAXX yield moves with short-term Treasury rates. As the Fed cuts, Treasury yields fall, and your money market return drops proportionally. Currently sitting at 3.59%, it could easily sink to 2.5% or lower if the Fed continues cutting through 2026. Neither option protects you from rate risk. Both fluctuate with monetary policy. The only difference is high-yield savings banks sometimes cut rates slower than money market funds to retain customers. Sometimes. Don't count on it. Liquidity risk presents differently for each option. High-yield savings accounts provide guaranteed access to principal. You'll always get your money back plus accrued interest. The Fidelity FDIC-insured sweep works identically. But if you choose SPAXX instead, you're investing in a money market mutual fund. While it maintains a stable $1 net asset value, it's not guaranteed. During financial crises, money market funds have frozen withdrawals or broken the buck. Though this is extraordinarily rare for government funds. The last time a money market fund broke the buck was 27 years ago, and it wasn't a government fund. Still, the risk exists on paper. Platform stability matters more than people realise. Online banks offering high-yield savings accounts sometimes get acquired, merged, or shut down entirely. When Marcus by Goldman Sachs or Ali Bank changes policies, your money stays protected by FDIC, but the user experience can deteriorate overnight. Fidelity has operated since 1946. It manages over $14 trillion in customer assets. The probability of Fidelity disappearing or making drastic negative changes is microscopically small compared to newer fintech banks. Stability has value, especially for long-term financial infrastructure. Customer service quality separates winners from pretenders. High-yield savings accounts offered by online-only banks typically provide phone support during business hours and email support around the clock. Some offer weekend phone hours. Most lack physical branches entirely. If you need face-to-face help or prefer in-person banking, you're out of luck. Fidelity operates over 200 investor centers across the United States. Walk in anytime during business hours for help. Their phone support runs 24/7 for account emergencies. The quality consistently ranks high in customer satisfaction surveys because Fidelity hires knowledgeable representatives who solve problems rather than reading scripts. Let's break down the opportunity scenarios. If you're building an emergency fund and want maximum simplicity, a high-yield savings account at Openbank paying 4.2% makes sense. $500 opens the account. Zero fees. No complexity. Money sits there earning solid interest until you need it. Transfer to checking when emergencies strike. Clean and simple. If you're in accumulation mode under $50,000 in liquid savings, the yield difference matters more than convenience features. Squeeze every basis point of return. If you manage variable income as a freelancer, contractor, or small business owner, the Fidelity Cash Management Account wins decisively. Unlimited transactions mean you can pay yourself, pay vendors, receive client payments via mobile check deposit, and handle everything from one account earning interest on every dollar, every day. The debit card and check writing capabilities eliminate the need for a traditional checking account entirely. You consolidate accounts, reduce complexity, and still earn a reasonable yield. The time saved justifies the slightly lower rate. If you're actively investing and frequently moving money between cash and investments, Fidelity's integration is worth its weight in gold. The instant transfers between cash management and brokerage accounts let you seize market opportunities without the frustration of waiting 3 days for external transfers. You avoid missing trades or dollar cost averaging dates because money got stuck in transit. For anyone deploying $50,000 or more across various investment vehicles, this convenience compounds into significant value over time. If you're extremely rate sensitive and willing to move money frequently, consider using both. Keep your core emergency fund in a high-yield savings account, earning 4 to 5%. Use the Fidelity Cash Management Account for operating cash, investing activity, and spending. This dual approach maximizes yield on stable money while capturing flexibility on active money. Yes, it adds complexity. But for sophisticated savers managing multiple financial goals simultaneously, the optimization is worth it. Here's what most financial advisors won't tell you. The difference between 3.6% and 4.5% sounds meaningful on paper. But the real wealth gap comes from behavior, not basis points. If the Fidelity Cash Management Account's integration helps you invest an extra $500 monthly that would otherwise sit uninvested in checking, that behavior change crushes any yield difference. If the high-yield savings account's isolation prevents you from raiding emergency funds for emotional trades, that discipline creates more wealth than chasing an extra % of yield. The psychological dimension drives outcomes. Some people thrive with consolidated accounts. Everything in one place reduces mental overhead and increases financial awareness. Others need separation. Keeping emergency savings at a completely different institution prevents commingling and creates healthy boundaries. Neither approach is objectively superior. Know your tendencies. Choose accordingly. Want more in-depth analysis like this? Your likes and subscriptions help me know which financial topics matter most. Hit subscribe so you don't miss future breakdowns. Bottom line, after breaking down every angle, for most people optimizing pure yield on static emergency funds, high-yield savings accounts like Open Bank at 4.2% or SoFi at 4.3% deliver maximum returns with FDIC protection and zero fees. The slight edge in yield compounds to real money over years. But for anyone actively managing finances, investing regularly, or needing full banking functionality, the Fidelity Cash Management Account offers unmatched flexibility at a competitive, though slightly lower yield. The integration, unlimited transactions, global ATM access, and institutional stability justify the yield gap. If you're just starting out with under $10,000, pick the highest yield savings account you can find and keep it simple. As your financial life grows more complex with investments, multiple income streams, and tactical money movements, migrate toward Fidelity's platform. The sweet spot exists around $50,000 in liquid assets. Below that, maximize yield. Above that, optimize for functionality. The wealthy don't chase an extra 0.5% on cash. They build systems that reduce friction and increase execution speed. Sometimes the best return isn't measured in basis points, but in opportunities seized because your money was accessible instantly, instead of trapped behind 3-day transfer delays.